If you're just starting to learn about investing, you need to watch this video because I can almost guarantee you'll make at least one of these common investing mistakes. Let's jump right into it. One of the most common investing mistakes beginners make is chasing after performance. What this means is that you choose your investments based on how well they've performed recently. For instance, you might see a stock that's up 40% over the past 3 months and think, man, I should invest in that great company so I can get a huge return. But just because a stock went up 40% in 3 months doesn't guarantee that it'll do it again in the future. In fact, the only guarantee here is that the best time to invest in that stock was 3 months ago. Another common mistake people make is setting unrealistic expectations for their investments. Now, we've all heard the story of the young entrepreneur getting into the stock market and making millions of dollars overnight, but that just isn't realistic. You know what else isn't realistic? That you'll earn a 10% return on your investment. That's right, you may have heard that the stock market has historically returned an average of 10% annually, but you need to remember that 10% is the long-term average over decades. But in any given year, it's extremely unlikely for the actual return of your investments to be 10%. In reality, you'll see your stocks go up and down and sideways, so you need to be realistic about your expectations and not freak out. The third most common investing mistake is also my personal favorite, and that's not understanding your risk tolerance. Now, put simply, risk tolerance is your capacity to take on risk. In other words, not everyone can stomach high-risk investments that could lose half their value in a year, and that's okay. By being honest with yourself about how much you're okay with seeing your investments go down, you'll be able to make smarter decisions about what to invest in. People with high risk tolerance may be better suited to invest in volatile startups, but if you have low risk tolerance, you're probably better off just investing in well-established blue chips and government securities. Speaking of investments going down in value, if you're actively trading stocks, you need to be ready to accept when your trade just isn't working out and be able to move on to the next trade. New investors will often see some of their investments go down in value, and instead of selling it at a small loss, they hold on to it with the hopes that one day it'll go back to where they bought it at and they can at least break even. But the reality is that oftentimes when an investment is losing value, it's for a reason, and it's better to sell at a small loss instead of holding on to it until it becomes a big loss. Moving on, another common investing mistake is to not understand your investment time horizon. There is a huge difference in your mindset when you're investing to take your money out in 1 year versus 30 years. A stock market index fund, for example, might be a terrible investment if you're planning to take your money out in 1 year because it can fluctuate a lot in value, but it could be one of the best investments for you if you plan to set it and forget it for 30 years. This is why you should have an idea in your mind for how long you're planning to invest for. On the topic of index funds, an index fund is simply a collection of stocks and bonds that follow a certain market. For example, a technology index fund will probably hold all of your favorite tech companies like Google, Apple, and Facebook. The beauty of these funds is that they have diversification built in. Diversification is a way to reduce your risk by owning a variety of stocks instead of putting all your eggs in one basket. New investors often make the mistake of not diversifying enough and putting all their faith in just a few companies. The reality is that even large reputable companies can go out of business unexpectedly, so it's good to have a variety of stocks in your portfolio. Alright, so I've saved my 2 most important investing mistakes for last, but before I get there, I would love if you would take just a few seconds to hit that like button. It would really mean a lot. With that said, let's talk about common investing mistake number 7, which is investing before you are ready. What I mean by this is that you should have all of your high interest debt paid off and have an emergency fund of at least 3 months before you even think about starting to invest. Without these things, you might find yourself in a tricky situation where you have to sell your investments at a bad time to cover an unexpected expense or a loss of income. So just play it smart and take care of those things first. On the flip side, the most common investing mistake people make is not starting at all. If you're too afraid to invest and put your money to work for you, you're going to have to work 100 times harder in life just to make as much as someone that invested. Remember that when you keep your cash in a checking or savings account, the interest you get paid is almost always less than inflation. So you're actually losing value by keeping your money there. So why take a guaranteed losing situation by not investing when you can invest in your future? What are you waiting for? Your future self will thank you for it. That's all for today. If you liked this video, why don't you leave a like below? And if you're new to this channel, subscribe for more 5-Minute Finance.